This chapter is going to present a little bit different view on economics because up to this point we've mainly been talking about different types of economies, types of companies. We've been talking about costs, revenues, profits. We've been talking about making money and making a living, and now we're going to talk about after you've made that, what comes next. So after you've made your money, you paid your bills, you got leftover money as an individual or as a company. What do you do with it? Well, you don't really put it in your mattress anymore. Nowadays, you put it in a financial institution that's going to earn you some interest so that your money is turned into more money. You either save or you invest your money, and then often you invest that money into stocks, and stocks is the one that will take the most time to talk about. So we've already made our money, we've already done our job, we've already gotten our profits. So now, if you recall, way back when we did the 5-sector circular flow, and the flow of money is kind of going around, this is your income, and here is your expenditures. And then the first little sector right here that we added in, savings, was a leakage. Saving money, taking money out of the economy, is a leakage to the economy. And then later on, we invest it in other places. So we'll talk a little bit about that, and in this chapter, and we'll end up touching on stocks, and we'll do a stock simulation during this chapter as well. Now, this chapter on page 313 starts off with the description of the difference between saving and savings. I think that's fine, not a really important part, but saving is the absence of spending. So spending would be, consumption. We've been talking about consumption so far. Spending to buy stuff, buying different products, your supply, your demand, all that kind of stuff rolled together. Now savings is the absence of that. What are you going to do with the money that you don't use for consumption? And then the term savings is referring to the money that is available when you do save. So same idea, but in the book it's going to kind of use terms saving and savings, so don't get those ones confused. I want to kind of take this first section, and it kind of jumps around a little bit. I want to focus on a couple of big ticket items and get everything we need in this way. I want to start off with financial assets. A financial system, as listed in your book on page 314, says it's like a network of savers, investors, all the different companies, all the different institutions where you might save your money. The link between all these things, all companies that offer all this stuff, and the link that they have over here. So that's kind of a financial system. And inside that financial system is where you find your financial assets. Your financial assets might be wrapped up in a bank, which is kind of a place you put your money if you don't really try to grow it that much. You can have it in stocks, which is where you try to grow your money a lot. A pension fund for retirement, government bonds because they're very, very safe. Receivables, which is the money that people owe to you. You can buy real estate, livestock. You can buy all these different kinds of things. And these are kind of divided into your financial assets or money-based assets, and then physical assets or actual commodities, things that you own. So this is kind of a quick look at a couple of terms that are going to be used consistently when you're talking about finances, your financial assets. Later on, when you build your business plan, you'll start talking about the financial assets that your company has, the different machines that you own, the different everything from office furniture and computers that you own, all the different pieces of capital, all that kind of stuff. That's physical assets. And then your financial assets will be when you make money and you put it aside to save it for later. That's a financial asset. Your book does kind of put a funny definition on page 314 for financial asset: claims on the property and the income of the borrower. And that's kind of a typical definition for a financial asset. The fact that you have a claim on somebody else's property because you put your money into it. So if you put your money into a bank, you have a claim with that bank to go get that money back if you want to, plus interest. If you have a stock, you have a claim that you can go turn in that stock or sell that stock and claim value out of that stock. If you have a pension fund, you've been donating money into a pension fund or retirement account or something like that, you have a claim on going and getting that money back. Okay, so that's kind of what that definition means. It's a pretty good definition. It makes sense. And then comes a term on page 314, kind of a different looking term, a financial intermediary. An intermediary goes between borrowers and savers and such. For instance, this graphic represents regular people making deposits into like a bank, a different financial group that you can put your money into to save your money. All right, so your money is going to end up going into institutions like this. You got savings banks and commercial banks, mutual funds we'll talk about. But then your money is put into these different groups, different intermediaries, and then those intermediaries give money to investors. So if you put, let's say, $10,000 into a bank, the bank's going to take that money and loan it out to somebody to go buy a car or to go to college. Or if a big company puts $1 million into a bank, the bank's going to take most of that money and it's going to loan it out to somebody else to start a company. It's going to loan it out to a government. It's going to loan it out to whoever wants to take that loan. So they make money by loaning it out. These guys are going to make money by loaning it out. You make money from them. They pay you interest on it. So that's kind of what the intermediary idea is. Pretty simple idea, fancy term. And so certainly banks are the number one financial intermediary. It's easy. I never see my paycheck. My paycheck is sent directly from the school bank accounts into my bank account, and then I pay my bills from that one. All that happens with the help of the bank. But the bank will take the money that is put into there, right? When I put my money into a savings account, they'll take that one and they'll loan it out to somebody else. Somebody else will pay the loan back with interest, and then the bank will pay me back with interest. So this is just kind of the roundabout that happens. The banks are the number one financial intermediary. They're the main one that we use. There's a lot of them. There's tons and tons of banks all over the place. Local banks, state banks, national chains, international chains that you can put your money into. But then you've got your non-bank financial intermediaries. Non-bank ones, they do jobs other than just hold money and loan it out. One of these things, a finance company, this is a major one that's used quite a bit in America especially. If you've ever bought a car or been involved with the process of buying a car, you don't normally just pay $25,000 for a car. You pay maybe a down payment, and then you pay installments. Every month you pay $200, $300, $400 to get that car. Well, that's called financing. Financing because you are financing a portion of the purchase. If you buy a house, most of the time you don't lay down $300,000 cash for a house. You pay a down payment and then you make installments. Well, a finance company is a company that actually purchases the whole house, and then you make installment payments into the financial company. You pay maybe like $300 for a car, or maybe you pay $2,000 a month installment into the finance company, because they are financing the rest of your company. I'm sorry, the rest of your purchase, your car, a college education. They will finance things like that. You've got another one, like a life insurance company, New York Life. I put it there because we do some things with New York Life. But a life insurance company, you pay them a monthly installment, and they guarantee that if you do pass, that they pay a large payment to your family. So you pay money in there every month for whatever length of time you want to, and then when you pass, they pay you a big installment. You can get like $100,000, $500,000 life insurance policy, something like that, and then you pay into that every single month. And then they'll use those installments to pay people who do pass away. You'll pay their families some money. So life insurance is big when you pay what you call a premium. I'm not sure why this is not working over here. A premium. I don't know why this is not working. Sorry. You'll pay premium to get a life insurance contract. And every single month you pay them a little bit of money. Sorry about that. I don't know why this little rectangle over here on the right side is not working, but it is not working, so oh well. On page 316, we're going to come back to the mutual funds because that's kind of its own little sector there, but talk about a pension fund really fast. A pension fund is a retirement type account that you have through your business. Often you won't put any money into this, but every time, for every like year that you work at a business, they'll put a certain amount of money into your pension fund. And then when you retire, they'll make payments to you. It's kind of like Social Security, but it's not horribly run. Pension funds, they have problems with them. There are some issues, but in general, pension funds are solvent, and they're privately owned, they're privately run, so it's not taxing one person to give to somebody else. In this case, a pension fund comes from your business, so it comes from their profits. They become pretty expensive, and a lot of companies try to kind of cut them down because it is such a big expense. Last one to look at on this page right here, a real estate investment trust. This is kind of a funky one, but it's just like any other kind of investment. This REIT is a company where you may, as an individual, you may trust the real estate market, which right now is kind of a burgeoning market. It's kind of opening up after the 2008 crash. It's starting to regain some traction. So people are investing in these REITs, and then the REIT gets your money, the REIT gets your money, and they go out and they buy commercial land, they buy buildings, they buy homes and rent them out. And then the rental proceeds or the sale proceeds come back in. If they buy an expensive building and when they sell that building, then you get a piece of the profit. And then the REIT, the REIT, sends it right back to you. Okay, so it's just like buying a stock. If you think of a REIT as a stock, you buy the stock and then later on you sell the stock and the money comes back to you. That's kind of like what this is. So you're investing your money, in this case, in the real estate market, trusting that it's going to kind of take a hold again. So a lot of people are putting money back into REITs right now because they think the real estate market is about to rebound. But just as we were talking about with a bank, these are non-bank financial intermediaries where you put your money into them and then you get money back later on. These just are not officially banks. And when you guys took your risk assessment quiz, that's trying to see whether or not you are the kind of person who is willing to risk the money you've earned in something like stocks, or if you'd rather put it in something like a bond, which is very safe. A mutual fund is kind of in between there, right? As far as risk assessment, bonds are pretty safe. If they're from the U.S. government, then they go on the very safe scale. If you have a scale of safe to risky, bonds are pretty safe, right? Stocks are kind of over here. If you're really good at investing stocks, you can feel pretty confident at it. But stocks are definitely more up and down. A lot of people lose a lot of money in the stock market, so they're more risky. Well, mutual funds kind of fall in between, and depending on what kind of mutual fund that you have, mutual funds are generally more safe. So the word to make sure that you remember for mutual funds is going to be diversification. And diversification is the idea that you never put all your eggs in one basket, right? Because if you put all of your investment into one company's stock, if that company goes down, so does your retirement, or so does your college fund, or whatever it is that you're saving for. So diversification means if you have a chunk of money, let's say $1 million. If you have $1 million, you don't put it all in one stock. You put a little piece over here in this one. You put a piece over here. You buy a stock over here. You put some in a mutual fund over here. You put some in this, and so you put that money into different places to make sure that if something bad happens, that you don't lose the whole thing, right? So what a mutual fund does is it gives you automatic diversification. It automatically does that very thing. It does a lot of different things. For instance, it helps you to beat inflation because mutual funds usually get about 6, 7, 8% return, higher returns than bonds do. You're going to get more money usually with a mutual fund than you do with a bond. You can lose on a mutual fund, and you really can't lose on a government bond. But mutual funds are safer than stocks. You get the investment done by experts. Expert people are in charge of it. That's helpful. Professional managers are in charge of these things. Income taxes, you can pay less income taxes on the money you make from mutual funds. You're not forced to lock into it. You can put your money in, and next month, if you change your mind, you can take your money back out again with a small penalty, of course. Cost friendly. It's not real expensive to do so. It's transparent, which means they're not allowed to hide anything from you, and it helps you to diversify. The reason why it helps you to diversify is that a mutual fund is automatic diversification. Here's the idea of how it works. So you've got this big giant fund. I've got a friend who does this for me. His name is Kelly. Kelly will invest my money. When I give him money, I might give him a chunk of like $2,000 or $3,000 and tell him to invest in a certain mutual fund. He'll do that for me. So let's call this a stock fund. This is a fund, a mutual fund, with a whole bunch of different stocks. In other words, let's say this is made up of 50 small cap stocks. Small cap means small capitalization, the word capital. So this is a small company. So small companies tend to grow faster. So in other words, what this fund has a little piece of 50 different companies, right? Instead of having one big giant company that it's made up of 50 little companies. So let's say when I call my buddy up, Kelly, and I tell him, I've got $3,000, I want you to put it in a small cap fund, what he does is he goes in and buys $3,000 worth of this fund. A little slice of that now belongs to me. I own $3,000 worth of this fund. Now, $3,000 isn't very much. I mean, these funds usually range in the tens of millions of dollars each. You have some funds that are really big. They are worth billions of dollars. The fund is. That is called the net asset value. To find that net asset value, what you do is you take your total value of the fund. Let's say the total value of this fund is $20 billion, and you divide that by the number of shares. And let's say there are 1 billion shares. That means each one of those shares is worth $20. So that's how much I pay to get one share of this fund. So really quick, the mutual fund, it's a pool of investments. You can get a bond fund where they buy a whole bunch of bonds and you buy a piece of all these bonds. You can get stock funds. You can get large cap stock funds. You can get a mutual fund made up of life insurance contracts. You can get a mutual fund made up of almost anything you want to. But the mutual fund gives you that automatic diversification that you're going to want with your investments. This is a really good investment if you're not quite ready for the stock market yet. And I am not. So I have all of my money in mutual funds because I'm not ready to go into stocks yet. It is more aggressive and you get more growth than you do in bonds, but less risk and less growth that you'll get with the stock market. That's a look at the different institutions that are available for you to do your saving in. Now let's take a look at the actual practice of savings, the different strategies that you might use to do your saving. We looked at risk reward. We should have, or we will soon, look at risk reward in class. Risk reward, your book calls it risk return. Same thing. The idea here is that the higher you are willing to risk, the more you're willing to risk, the higher that your reward can be. If you're willing to risk money in speculative investments, speculative means you have to speculate. You almost have to guess whether or not they're going to go up. A lot of analysis goes into things like stocks, but nobody's ever sure. If you could be sure that a stock's going to go up, everybody would invest in it. Even I would. So speculative investments means you're kind of taking a little bit of a chance. A moderate risk investment means that you're probably going to make money. There's some risk involved, but with a moderate risk investment, your return or your reward tends to be a little lower. Lower risk investments, things like the mutual funds, bank deposits, government bonds, there's not much risk there. And then the lowest ones, almost no return, are things like your regular savings account in a bank. You're not going to get much money with that. Anyway, what this one is saying is that as your risk goes higher, the amount of money that you're able to make goes higher. So if you have a lower risk, like bank accounts, mutual funds, you're not risking much money, and you're probably not going to get as high of returns as you will with some other investments. So anyway, just understand the idea that the reason that the stock market pays out more money is because it is more risky. You might lose money into there, and that is depending on what kind of stocks you have. It could be like a speculative investment, which is kind of, sort of, at least a little bit like a guessing game. So that risk-return relationship is kind of one of what your book calls an investment consideration. You should think of that. Decide whether or not you are willing to risk a lot of money, or are you going to be more safe with your investments. Some of the other objectives, your book talks about the objectives that you might be thinking about. Nobody should go into investing and just say, I don't know, I'm just going to throw my money out there, see what happens. You always have some kind of an objective. Everybody should have a retirement account, every single person, because if you're thinking that Social Security is going to pay enough for you, you need to do a little bit of a research on that. About Social Security is going to get you about $1,300 a month right now. $1,300 won't pay a whole lot of people's rent. You move into a lower level area, maybe you can buy now. Maybe you can buy groceries too. It's just not a lot of money. So you're going to need to have some retirement. You're going to need to have your own investments. So we'll talk about that in class, and we'll kind of go over some of those ones. Large purchases, if you're going to save or invest in order for you can buy a house at some point, or if you want to go ahead and buy that boat, you want to buy a vacation home or whatever else, your large purchases, you save for that. You can save for liquidity purposes, meaning that you need like an emergency fund. So if you want to have like a $10,000 emergency fund, so that if something big happens, you don't have to use your credit card or whatever else, then you need a highly liquid account. Now, if we haven't gone over this yet, let me mention the idea of liquidity is that you can turn your money into cash fast. So if I put my money in the stock market, and let's say my air conditioning goes out and I need $5,000 to replace my air conditioner, it's sort of difficult for me to get my money straight out of the stock market because I have to find a buyer. And I know you can do this stuff on your phone, but it doesn't happen in a matter of minutes because you have to find a buyer first. And if you can find a buyer, then you have the transaction. It'll take a little while. So stocks are kind of a medium liquidity. Bank accounts are absolutely liquid. In other words, I can get the air conditioning unit installed, and I can just hand him my debit card, and he takes it off my debit card and paid. So it's extremely liquid. But if I have my money, let's say I put my money in a REIT, an REIT, that means my money is in a real estate investment, and I don't get that money back right away. I don't get it until somebody else pays their rent. I may not get it until the end of the month. So that's not very liquid at all. If you put your money in a physical asset like gold, that's not very liquid. You can sell it, but it'll take you some time to get that sale going. So those things are not exactly what you would call liquid. So if you need like emergency money, then you need very, very liquid investments. If not, you can put it in some longer term ones or lock it up in something like an annuity we'll talk about later. And the last one is like living expenses. If your goal is just to make sure that you have enough living expenses, then you put it into something that's kind of moderately liquid, and you can plan on time when you need that one. Anyway, your book kind of talks about those objectives. Another one of the objectives is simplicity. Just do what you know. Don't try to do things that you don't know. I mentioned I'm 48 years old, and I still have not invested in stocks because I haven't researched that enough. I got my money in mutual funds because I've researched those, and I know those fairly well. I'm just not ready for stocks yet, right? So we're still in the simple mode where I haven't decided to put any money into stocks. Call me a wimp or not, my money is still growing and I'm not losing anything. Another one is consistency. This is the idea that instead of just putting $1,000 in at the beginning of the year and then not touching it, instead you put like 100 in and then 100 and just keep on investing. Keep on putting little bits in. Now you can put 1,000 in if you want to, but don't stop investing. Keep on putting more and more money because those little deposits really add up. You want to put 1,000 in January? Great. February, put 100. You maybe get up to like May or something like that. You want to put in 50 in? That's fine. But be consistent. Keep putting more and more money in because long term that money is going to blow up. And in class we'll look at compound interest that Albert Einstein called the eighth wonder of the world. It is a pretty cool thing to look at. Now at this point, on page 320, your book goes into 401k plans. I'm going to skip that until a little bit later when we go over different types of investments like IRAs. Instead, we're going to jump over to bonds, which start on page 320, but most of it here is on 321. For a bond, your book goes over three components of a bond. We're going to go ahead and do four because your book really doesn't mention the issuer, and the issuer is kind of important because the issuer is the organization that issues the bond. And we've talked about government bonds last semester. This is how government gets their money that they loan that has added up to our almost $20 trillion of debt that we have. Well, those are through bonds. If our government needs money, it sells bonds and it promises to pay you back later on, so that's added onto the debt. Right? Now, you also have corporate bonds, and we'll talk about a little bit more a little bit later about corporate bonds, but those are different issuers. You can have a company that does it, you can have a city that issues bonds, you can have the federal government that issues bonds, so that's pretty important. The principal is going to be the main part of the bond. You call it the face value. It's the amount that's actually on the bond. So if you buy like a $10,000 bond, and that's listed as the principal or the par value or the face value, those are all words for the principal. The coupon rate, this is the interest rate, right? It's the interest you're going to get on that. So like it's going to say like 3.4% interest rate. That's called your coupon. I don't really know who names these things. I don't get to make the rules, so we'll just go with coupon and let them have their fun. And then the maturity date. Now the maturity date is when it comes due. So somewhere on that bond it's going to say, if it's like a 10-year bond, it's going to say this is going to come due in February, that's an F, of 2027. There we go. In 2027, this comes due, so that's the maturity date. So those are the components of a bond. Those are the different things on a bond that you need to kind of be able to recognize. The prices are interesting because let's say it is a $10,000 bond. Most of the time, if it's a really, really good bond, then it sells for $10,000. So $10,000 par value or $10,000 cost on the bond, then your price is actually just going to be that amount. You're going to pay them $10,000. But there are some bonds that they're not as good, like some of the corporate bonds or sometimes some of your city bonds. They're not quite as good and not quite as safe as a U.S. government bond. So they might sell that bond for like $9,500. So you get a $10,000 par value, but you only pay $9,500 to get that. And then when it matures, when it reaches maturity, you get $10,000. So you make $500 just for buying that bond. And then you also get the interest on there. So that's pretty cool. So prices can kind of vary up and down as well. And then on the yield helps you to be able to compare bonds. Here's how the yield is going to work. Let's take, let's say that $10,000 bond. That's a par value, and let's say your coupon is 7%. And so what that means is that every single year they're going to give you 7% of $10,000 as your interest, right? So every single year you're going to get $700 in interest, right? That's what they're going to pay you for having this bond, right? So how you find the yield for a bond? It's pretty simple method here. What you do is you take the annual interest, which is $700 right here, and you divide it by the bond price. Now, in this case, when you do this, you're going to find out that your bond yield is 7%. When you divide 700 by 10,000, it's going to give you the 0.07 or 7% bond yield, and that makes sense because you're 7% coupon. But let's say that you didn't pay $10,000. Let's say you got the $10,000 bond for, let's say, $9,300, and you still have the coupon of 7% interest. So to figure that one out, you're going to take 9,300, and you're going to find out that you're going to end up getting $651 per year in interest, not 700. Wait, scratch, stop, hold, turn around. If you pay $9,300 for the bond, I'm skipping a step, $9,300, it's a $10,000 par value and a 7% coupon rate. I'm sorry, you're still going to get $700 in interest per year. That's how much you're going to get. So that's your annual interest. But to find the yield, you're not going to divide it by 10,000 because you didn't pay 10,000. You're going to divide it by 9,300. And when you take 700 and divide it by 9,300, your yield is now 7.5%. Your yield just went up. Instead of 7% on the last bond, your yield is 7.5%. So what this helps you to do is it helps you to compare if somebody's selling a bond of $10,000 bond at 7%, the yield is 7%, but if that $10,000 bond is being sold for a lower price, $9,300, then your yield is higher, and the higher the yield, it means you stand to make more money on this bond. Now, quick note, the U.S. government doesn't usually sell bonds for cheaper. They just sell them. And they're very, very safe, and they don't usually give you high interest rates like 7%. Most of the time, 2, 3, 4, 5% would be the maximum that you'd ever get from those. So what this graphic right here is showing you, the higher the price of the bond goes, the lower the yield goes. That's why this graph looks kind of like the demand graph, right? The higher the price of a product, the lower the demand. Same thing here. As the price falls, the yield goes up. So a lower price down here, you see the lower price has the higher yield. Because if the price of a bond goes down, and bond prices do kind of fluctuate up and down, if the bond price goes down, your yield is going to be higher. You're going to end up making more money off that bond. We'll do some more examples of that in class. The last thing for bonds, these two companies, Standard & Poor and Moody's, these are the two biggest bond rating companies. A bond rating company is a company that looks at the bond and decides if it's safe or not. And it will give ratings to certain bonds. Like U.S. government savings bonds are typically AAA rated. In other words, it's the highest rating that you can get. Bond ratings will be AAA, AA, and go through your B's and C. I think you even have some D's, and then you have the really bad ones called junk bonds. Junk bonds are very risky, and since they are more risky, you ought to know, of course, that what should be higher since they're risky? Well, the reward should be higher. So junk bonds usually have higher coupon rates. That's where you'll get like 6 or 7 or 10% interest on a junk bond. That's usually like a company that is in bad shape. It can't borrow any more money from like a bank. It can't get any more subsidies from the government. So they might sell out or send out some junk bonds and give you a 10% interest rate and a low price on the bond. So bonds are more than just what we looked at last semester with the government. Bonds actually have a lot of different pieces to them. They can be good investments if you buy the right ones. So to look at some of the specific assets that your book mentions here, a CD, a certificate of deposit. These are mainly from banks. You put your money in the bank for a certain amount of time. You might do everything from like a 3-month CD to like a 10-year CD. Banks like CDs because you're telling them that you will leave your money in that bank for a certain amount of time. So they don't have to worry about you putting $100,000 into the bank and then trying to get it back next week. And they have to go scramble and find $10,000 to give you. Instead, if you give them $10,000 on a 1-year CD, they know they have 1 year before they have to have that money back and ready for you. And so that helps them to plan better. So with CDs, if you get a CD, they give you a little bit higher rate than just a regular savings account. A savings account is very liquid. You can get your money at any time. Just go up to an ATM. Usually, you can get your money back. But for a CD, you have to promise to wait. And let's say if I put my money into a 1-year CD, and then 6 months from now I really need that money, if I go to them and take it back out, I have to pay a big penalty. Usually like a 5 or 10% of my money, I have to lose it in order to get the CD out early. So CDs can earn me more interest in a bank, but it's usually pretty low interest, and unless there's some specific reason why you want it in a CD, those are not usually your best investments. You have corporate bonds, and we just talked about bonds. A corporate bond is when a corporation sells a bond. That's where you can get your lower priced bonds. That's where you can get your higher interest rate bonds. A municipal bond, these are cool. If I had the ability to do so, I'd put all of my money in municipal bonds, at least from my understanding. These are city bonds. So like when the city of Sugar Land or the Fort Bend County, let's say, Fort Bend County decides they want to raise money for schools, so they vote on a bond issue. If you guys ever go to vote in an election and you see something about a bond issue, it means a certain city or a county or the state of Texas, somebody wants to issue bonds or go into debt in order to do something. So let's say Fort Bend County, they want to float $50 million of bonds, and they want to use that $50 million to upgrade all of the public schools in Fort Bend County. All the schools are going to get $1 million or so to upgrade and make things nicer and so on. So let's say Fort Bend County floats $50 million of bonds. Then you can go buy those bonds. If you want to, you can go buy, let's say, a $10,000 bond. What's best about these municipal bonds, and your book mentions this as the most important thing, is that they are tax exempt. You don't pay any taxes on the money you make. So if I give them $10,000 for 10 years on a bond, and let's say over time I end up making $2,000 in 10 years, I don't have to pay any taxes on that $2,000. And that's a pretty big thing, because the government always makes you pay taxes on what you earn, on your income. Well, this is income that's actually not taxed. So it's kind of a special kind of a thing. So municipal bonds are awesome because you don't pay taxes on the money you make. So if you ever have the chance to get them, I recommend it. Now, here's the problem, is that usually when those bonds are floated out there, usually they're gobbled up by big corporations and stuff. They're gobbled up by maybe big investors. It's hard to get municipal bonds. But if you're able to, they're really, really, really cool. A government savings bond, we've talked about those ones. Government savings bond, where the government goes into debt, $20 trillion of debt. We've talked about those ones already. But then you've got T-notes, T-bills, T-bonds. You can read over those things. They're just kind of different government assets. For instance, like the T-notes are they're kind of like different government securities, whether bonds or not. Where the maturity is between 2 and 10 years, and then a T-bond or a Treasury bond is from 10 to 30 years. You're going to give them your money. So if you get like a government savings bond, let's say that is a 20-year bond, that's called a T-bond because it's between that 10 and 30-year mark. Okay, and then a Treasury bill is a short-term obligation, short-term, less than 2 years. And a lot of people like to buy T-bills. Now, let's say I have $100,000 laying around, and the economy is not really good, so I don't want to put it in the stock market. I may stick it in a T-bill for a year or 2 years just to kind of try to get some quick, easy money. And the government always pays its obligations. The government always pays it's money that it owes. So you're going to get your money back, and then you can take it in 2 years and decide what to do with it then. Okay, so those are what the T things are: T-notes, T-bonds, T-bills. Those are all, the T stands for Treasury, and those are all government assets. Now, on that retirement account front, these are, again, just looking at different types of investments, different ways of investing your money. You've got two kind of things, big things nowadays to put your money into. You've got a 401k, and then you've got an IRA. 401ks have become very popular because of one big portion of it. A 401k is like a retirement account through your employer. Your company kind of sets this up with you. And then the thing is that you can put money into retirement that you don't have to pay taxes on right away. Let's say, for instance, let's say I make $100,000 a year, and I'm going to pay taxes on that $100,000. I pay income taxes on that money. I pay Social Security taxes and so on. But let's say during that year, let's say I put $10,000 into a 401k. Well, now instead of $100,000 getting taxed, I only have $90,000 getting taxed, because this $10,000 right here, I didn't pay taxes on that money because I put it into my 401k. I put it into my retirement account. So I'm paying less taxes. I'm only paying taxes on $90,000. So that's what it's called tax deferred. I'm not paying the taxes now. It goes into my 401k, and then later on when I retire with all these millions and millions and millions of dollars, then I'll pay taxes on it. But that's after it's already grown, after it's already, millions and billions of dollars that I'll have when I retire, right? So that it's called tax deferred, and your book mentions that term, tax deferred. People really like that. But here's usually the coolest thing about 401ks is, let's say I have a 401k, and let's say every month I put $200 into my 401k. Often, and not always, but often, your employer has a chance to also put matching funds. So matching funds are really desirable with 401ks. Where I put $200 in, and if I put $200, then my employer will also put $200 in. Now they have to pay for that; it's a cost, but it's also one of those fringe benefits we talked about way back in Chapter 3, where some companies offer these fringe benefits, these extra things. Like if if you're deciding where you want to work, and this person or this company pays one amount, this company pays a little bit more, but this company pays me a good salary and offers me a 401k, and they match my funds, matching funds. Then I may choose that one because it's got that extra really cool benefit. Now, this book is kind of old, so just so that you know, we have new accounts, and these are kind of based on different parts of the tax code. But now we also have one called a 403B. And a 403B is kind of the same thing as a 401k. Sorry to confuse you with numbers and stuff. It is the government that sets up the names for these accounts, not me. But a 403B kind of does the same kind of a thing, where I put money in and my employer can put money in too, and we can match funds. They can decide to put 2% of my salary in for the year, no matter how much I save. Either way, as employer matching funds, that's kind of the coolest thing of a 401k or a 403B. An IRA stands for Individual Retirement Account, and IRAs also have tax incentives. Your book uses the term tax shelter. It's kind of a place to put your money and shelter your money from taxes until you retire. And when you retire, you're in a lower tax bracket because you're not working anymore. So you're in a lower bracket and you pay lower amounts of taxes. So you get to put your money into the IRA without paying taxes. And then when you retire and you get out, now your tax bracket or your tax percentage that you have to pay the government is going to be lower, and that's good. And you're millions and millions of dollars. So you deferred taxes like you did with a 401k. So the same kind of an idea, and they have some different rules with them. You have to look them up when it comes time for you to open up an investment account, a retirement account. Now, the Roth IRA has kind of a different look to it. It's kind of a cool way to go. If you, it's kind of cool because a Roth IRA, what you do is you make your $100,000 and you pay taxes on all 100,000, and then whatever you have left over, you put some of that into the Roth IRA. So you've already paid taxes, so that when you retire and you take your money out, you don't pay any taxes. You pay no taxes over here in retirement. And some people like that, because even though you're putting less money in because you're getting taxed on the 100,000, you might not be able to put as much money into the Roth IRA. You when you get it out, you don't pay taxes. Let's say from age 18 to 65, 47 years, you're putting money into the Roth IRA, and you had to pay taxes on that money. But let's say now that you're retired, you've got $2.3 million in that account. You don't pay any taxes on that money. You just get to take out this $2.3 million of just pure profit. So that's kind of cool too. So either you can go tax deferred with the IRA, where you pay taxes at first, you don't pay taxes at first and you pay them at the end, or you go ahead and pay your taxes now and then don't pay them when you retire in a Roth. I mean, these are kind of technicalities, they're kind of technical things, but you are being told this when you're 18, because 18-year-olds who think ahead, 18-year-olds who are future thinkers. I've had several students start retirement accounts at age 18. It's not a problem. And you put $10, $20, $25 a month. Maybe ask your parents for matching funds. I'm just saying. Don't tell them I said that. If you do, I'll tell them somebody else made this podcast. But ask your parents for maybe matching funds. You put 20, they put 20. Anyway, when you're 23, 24, getting out of college, you're starting off your career, you're already starting with several $1,000s in this account instead of starting from zero. And just wait until we get into class and we start going over how that looks. That little head start that you get makes a big difference later on. Anyway, those are the retirement accounts. Why don't you take a look at those? It's pretty cool. Pretty cool thing to think about. All right. The last part of section 2 goes over markets, two different divisions of markets. These different investments can be in a capital market or in a money market. A capital market is a market that where the money is loaned for more than 1 year. Capital markets would be bonds that may be a 5-year bond. That's capital market. Maybe different loans that you get that take a long time to pay off. So those are any investment that is going to be invested for over 1 year. Capital market, and then money markets are less than 1 year. These are quick investments, maybe a quick CD, maybe a stock, because you can put it in and take it out tomorrow if you want to. So different ways of looking at those markets. Now, take that capital market, because money markets, they're not going to have primary, secondary. A capital market has a primary market where you make the initial investment, and then it's got a secondary market, meaning that I may purchase, let's say, a house, and then 5 years later I sell it to somebody else. It's sold on the secondary market. Or I may purchase a stock in a primary market, and then later on I sell it, so it's sold on the secondary. After it's been purchased one time, it's sold on what you call that secondary market. So the primary market is where something is sold, and the secondary market is where something is resold. That's a great R. Is resold. And section 3 is going to be pretty quick, just talking about stock investing. Stocks are the ones that are talked about most. It's the ones that we follow the most when you watch the news shows. They talk about a lot of different types of investments, but stocks are the things that people hear about. It's the things that get our blood boiling and get our brains going when we talk about investing in stocks. Real quick definition for terms. You've got two different terms kind of here that confuse some people. Used to confuse me before I got into economics in college. You have equity. Equity is kind of a different word for ownership. If you have equity in something, it means you own something. If you have equity in a company, think back when we went over chapter 3, different types of businesses. One of them was a corporation where you sell ownership in a company. So if I buy a company's stock, I have equity in that company, but the equities themselves, these are the actual stocks. So if I say I'm going to invest in equities, I often am just talking about stocks. Now, there can be other things. Equities can be expanded to mean other types of investments. But most of the time, when somebody talks about equities being traded, it's talking about stocks being traded. So don't confuse the terms. Equity means ownership. Equities is typically talking about different stock investments that are being made. Your book introduces on page 329 a quick term, but it is used quite a bit, and I learned about this one in college in both of my economics classes. The efficient market hypothesis. Your book puts this in pretty good terms. It starts off by saying the idea is that stocks are always priced about right, and so bargains are hard to find. Because there's a lot of people who spend a lot of time trading stocks. You have day traders who sit in front of computers and stuff all day long, it seems, and they buy and sell stocks back and forth and try to make money during, I'll buy a stock at 10 a.m. and I might sell it by 11:30 a.m. after it's gone up a little bit. So you have people who do that. You have people who do this for a living, people who have millions and millions and millions of dollars invested. So what this means is that they're always, always, always looking for the best deal. So by the time you get on the stock market scene and you're trying to look for the best deal, it's already been found. So with the efficient market hypothesis, the idea here is that it's hard to find a deal because the deals have already been found. Okay, so this is kind of where a guy like me would deal. If I was going to invest in stocks, I would be dealing down here on the weak level, meaning that my basis for buying stocks is going to be what the price used to be. I check the prices. I look at the fact that the last 5 days, maybe, the price of this stock has gone up. Or maybe the last 3 months, the price of this stock has been slowly increasing. So I say, okay, I'm going to buy this stock now because I think it's going to continue to go up. Right? Or maybe the price has gone down, so I think it's time for it to go up. So now I invest at just the right time. I try to hit it just perfectly. So that's kind of a weak level of investment. And probably most people are on this level right here. Probably most people who invest, if they don't do it for a living, they invest kind of on this weak level where your information is kind of, bottom level kind of information. You don't do this professionally. You just kind of do this on your own. With pricing and such. The second level will be public information, where you know how to look at different kinds of analysis, some technical analysis of a business, and you're able to look at 10, 20, 50 different indicators for a company and decide if that is a strong company or not. If you get public information on a business and you invest with public information and you know how to use that information, that's a pretty strong way to invest, right? And then you got these people up here who are professional investors, and they deal with a lot with private information. They might work with a company that has some private information, or they may know how to get the private information themselves. But these are the ones right here who are going to get the best deals, usually. Not always, but usually these are the people going to get the best deals. So what happens is that people like me, I'm down here dealing as hard as I can trying to buy the right stocks, and I might buy the right stock. I may buy a stock and boom, it just kind of blows up and hallelujah, I have retirement. But it's hard to do that because the people that are up here are already searching out the deal. So the efficient market hypothesis is the idea that it's hard to find deals that nobody else knows about. So I guess the lesson would be, and you don't have to believe this, by the way, because it's not absolutely true. Certainly some people invested in Apple way back in the day because somebody just said, I don't know, I'll try this Apple company, and boom, it exploded, and hallelujah, you've got your retirement, and your spouse's retirement, and your children and grandchildren and great-grandchildren. You got all the retirements because you invested in Apple at the right time, right? You've also got the thing where, just like when Trump won the presidency, the next day, the stock market tanked. Well, even a weak investor, even somebody down here knows that when a really good company tanks in one day, you go in there and you can buy it at low because it's going to go back up again. So the efficient market hypothesis isn't absolutely true. This isn't a truth. It's an idea. So because of this idea, what this teaches you is that you need to invest with simplicity, if you recognize that from before. You need to invest with consistency. Put money in over and over. Don't throw money in all at one time on a hot tip that you got from somewhere. You be efficient. Be smart. Use the market. Watch as closely as you can. Maybe use a stockbroker. On page 329, it uses the term stockbroker. This is the person who buys or sells equities for you. And you might use one of those. Might be helpful to you. Diversify. Make sure that you diversify because if you're buying on weak information, you might end up losing some money. Anyway, this is what the idea teaches. It's a good lesson for everybody to take hold of. All right, let's take a look at the asset allocation. We looked at this when you built your stock, or sorry, your risk assessment. When you took that quiz online and built up your risk tolerance or your risk assessment. If you are a conservative investor, you don't put a whole lot of your money into stocks. You put more into bonds because bonds are pretty safe. 10% into cash because cash is really safe. Of course, if you spend it, it's gone. But it's pretty safe. The FDIC, if you lose all your money in a bank, it gets returned. So cash is a pretty safe one. A moderate portfolio might include something like 50% stocks, 40% bonds, and 10% cash. And then you got your aggressive, and 70% stocks and 25 bonds and so on. So the more you put into stocks, the more aggressive you are, or the more risky that you are. And risk ends up being typically ending up with return. Now, it doesn't mean if you risk more money, you're going to get more return, because the other side of that is the more you risk, the more you stand to lose. So if you put 70% into stocks, you could stand to lose an awful lot of money. That's why it also is true that as you get older, when you're aggressive, you might be a little bit younger, because if you lose 20% of your retirement when you're 30 years old, you've still got 35 years to make it up. But if you're 60, you can't stand to lose 30%. So when you're 60, you tend to be more conservative and making sure that you're not going to lose that money. So anyway, the asset allocation is just talking about if you're a riskier person, where you put your money. If you're at the beginning of the road, you might be more aggressive. Asset allocation is just talking about what you put your money into. Now, you're going to put it into stocks, you can put it into mutual funds, put some over here into a CD, depending on the amount of risk that you're willing to take on. All right, let's look at a couple things that often get confused: exchanges and indexes. An exchange is a place where stocks are actually traded. New York Stock Exchange being the most famous one, the American Stock Exchange also in New York City. You got NASDAQ, which doesn't have really a physical location. NASDAQ is an over-the-counter market, meaning that it's just kind of, it's like an online market. where stocks are sold kind of on the internet. Um, your book calls it an electronic marketplace, and you get the idea. That's an over-the-counter market, whereas the New York Stock Exchange, the American Stock Exchange, those are physical places you actually go into to make your trades there. You can also call somebody to do it, but they make the trade there at those exchanges. Your book goes over regional exchanges. Sometimes cities have their own exchanges. I mentioned Chicago, Philadelphia, Boston, and so on. Global stock exchanges. You have some places. Tokyo, I think, has the world's biggest global stock exchange, where you can buy stocks from all different countries on that stock exchange. So you have different kinds of exchanges. Now the other one is these are indexes. An index is a listing of stocks, so you can kind of track them. Like the Dow Jones. Dow Jones is the most famous one. Every time somebody on TV or on the radio, they start talking about how the markets did, usually the Dow Jones is the first one they mention. The Dow Jones, for the first time ever, just passed 20,000 this year. 20,000 in value, which is pretty impressive, because I remember just a few years ago it passed 12,000 and people were freaking out about how big it was getting. Just a couple years later and we're 20,000. Yeah, it's getting really big really fast. I don't know if that's good or bad. Maybe if I use this podcast in the next couple of years, I'll look back and laugh as it passes 30,000 and then crashes down to 5,000. God forbid, let's hope not. But right now, 20,000 stock values in the Dow Jones. So when you hear him talk about the Dow Jones, it's an index that has 30 giant companies, right? This is the Exxon, Walmart, big giant American companies that are in the Dow Jones. There's 30 companies, and if their stocks and stuff go up, then the Dow Jones goes up. If their stocks go down, Dow Jones goes down. It's been on an uptick now ever since the day after Trump's election. Standard & Poor, or S&P 500, is another stock index. NASDAQ is not only an exchange, it's also an index that you can look at and see. It has a listing of companies. So take your Standard & Poor 500 companies that are listed on the S&P 500. These are good companies, strong companies. They're not giant ones all the time. NASDAQ tends to have like electronic type companies. A lot of tech companies are on the NASDAQ because, it's online, it's over the counter, and they like that. So don't get exchanges and indexes confused. An exchange is the place to go to buy stocks. An index is a listing of stocks so you can track how they're doing. All right, let's wrap up this chapter with a couple final ideas. One of them is bull and bear markets. These are just nicknames for either good or bad markets. A bull market, and the idea here is that the bull lowers its head and then swings its head up really fast, which means if the market is heading up, then it's a bull market. And then a bear tends to take its paw and swing its paw down. So if a market is doing badly, it's called a bear market. Again, I don't make these rules. I don't make the names. Don't blame me. But a bull market means things are good or people are optimistic about the market. Bear market means that people are kind of, slow down. People pulling their stocks out. They're kind of scared. Right now we're in a bull market. In fact, right now we're in one of the biggest bull markets ever, as we've just passed 20,000 on the Dow. Bulls and bear markets. All right, last item is the future market. I'm really not going to go deep into this because if you're not ready to invest in stocks yet, then you're definitely not ready to invest in futures yet, and options and things like that. But we'll just take a quick look at the terms so you understand what they're talking about. Let's recognize first that spot and futures are opposite. A spot market is any market that sells at a current price right now. For instance, if you're looking at the price of, let's say, Exxon. You want to buy Exxon stock, and let's say it's trading at, I'm just making up a number here, let's say it's trading at $29.30 per share. So if you buy 1,000 shares at $29.30, you pay $29,300, and you made a spot market transaction. In other words, at that moment, it was $29.30, and you bought it at that price. A futures contract, a futures market, is where you're actually purchasing a stock based on the future. In essence, what the futures contract, which is purchased on the futures market, what those are talking about is let's say I promise to buy Exxon stock at $30 in June of 2017. So on June 1st, I promise to buy 1,000 shares of Exxon at $30. So it's kind of a weird way to do it, because what happens if the price goes above $30? Well, I get to buy it at $30. Yay, so I made a good decision. Of course, if the price goes down to like $25, I have to buy at $30. Yikes. So a futures contract is not only kind of risky because you're buying stocks, it's also risky because you're buying stocks at a future price and you don't really know what's going to happen with the price. You're kind of making an assumption, hopefully an educated guess, at what's going to happen with that stock price in the future, and you're promising to buy the stock at a future price. You can also do that with anything. Your book mentions you can do it with gold, you can do it with commodities, you can buy livestock at a future price. You can buy kind of anything at a future price. Options are kind of the same thing. Options deal with the same idea as future markets. Your book says options are contracts. You drop a contract, like you would for a futures contract, provide the right to purchase or sell commodities or financial assets, or commodities are just goods, or financial assets like a stock, at some point in the future at a price agreed upon today. So it's kind of the same idea as a futures contract, and I'm sure that somebody who invests in stocks for a living is going to tell you, no, they're totally different. Look, for our class, for right now, for your basic learning on investments, we're going to go with futures and options are definitely in the same arena, as far as you're not buying the stock now, you're promising to buy or sell it later. So you have call options. A call option gives you the right to buy a share of stock at a certain price in the future. So let's say I'm saying in October of this year, I want to buy Exxon at $31 because I think it's going to go up, and it goes up to like 35. I buy it at 31. I'm happy. A put option allows you to sell a share of stock at a specific price, and that one gets kind of weird. So just kind of understand that call options allow you to buy a stock or a commodity, usually a stock, in the future, and then a put option allows you to sell a stock at a certain price in the future. And these are all sold on the options market. Every stock exchange that sells stocks on the spot market also have a future and options markets. All right. Hope that wasn't too weird or too confusing. If you like investing, you probably like this kind of stuff and you're eating it up. All right. God bless.